And your final point, market dynamics go beyond Fed policy. This is something that really plays into the art and the science of what we do. Why, in some instances, knee-jerk reaction of certain headlines and certain policy implications can fall into place, or why they may not.
Yeah, the Fed policy tends to remain very data dependent. And again, their two major focuses are maximizing employment and price stability. Inflation plays into the price stability part of that, and inflation weighs heavily on fixed income because of purchasing power erosion. But there are often times when major factors outside of that can influence a flight to safety. If people are concerned about current growth or future growth, that may lead them to going more towards cash or to fixed income. Cash is wonderful. Last year you got a good 5%, but that's all you're ever going to get. In the face of any sort of macro event, cash is not really going to help you on sort of that downside risk. Whereas with fixed income, you look at something like 2023, the fourth quarter, we seem to have gotten past some of that hump with inflation, but interest rates weren't completely off the table in terms of rate hikes. The Fed did sort of tell us that we may have a bit of a pause for a while, and that was great for bond markets.
So one of the things that really speaks to the market dynamics going beyond Fed policy is this simplistic idea of the Fed controls short-term rates, but longer-term rates are market controlled. And this is something that we saw play out last fall